How's it going, everybody? Antonio here for some research talks, but this time I'm not doing the talking. It is Mark who sat down with David Morgan, the self-proclaimed silver guru, who actually does not like to be called that way, but he's also a longtime newsletter writer. And this one, they actually talked for about an hour or so, and they talked about pretty much everything that there is to talk about right now, from the banking crisis through gold, through silver, to platinum, which you'll be hearing about here in a second, where well, actually, if I decide to shut up eventually. But they also talked about tellurium at one point, which is it's a very obscure metal that is not as widely discussed out there. So if you want to listen to that full conversation for free, you can find it on resourcetalks.com under the tab Early Interviews, where talks like these get shared before I make them into clips and throw them on YouTube. And if you want to get notified again for free, just join the Discord server at, again, resourcetalks.com. And now let's hear from David.
We've heard a lot in the last month about the effect of interest rate rises on financial institutions' balance sheets. And that's because, of course, the market value of government bonds is inversely related to interest rates. So as rates rise, the market price of the securities drops, potentially leaving a black hole in bondholders' balance sheets. So with trillions of dollars of government debt held by banks and pension funds all around the world, in your view, should we be worried about the liquidity and solvency of the global financial system?
Well, absolutely. I mean, it's a liquidity squeeze that will continue. And the typical liquidity squeeze is probably best demonstrated by John Exter in the inverse pyramid, showing that we really have a financial system that's an upside down pyramid. As you come from the bottom to the top, you go to higher and higher liquidity. So it starts off with the worst of the worst, which is derivatives, and then it moves into unsecured debt, and then you get down to secured debt by sovereigns like government bonds. Then you get into short terms like T-bills, and then you get into cash money of various currencies, and you get into the US dollar, the supreme reserve currency, and then you drop down to gold and silver. So we are in a liquidity squeeze, and I believe it'll continue one of two directions. If you let the market actually determine interest rates, then you could be at an 8%. I don't know. There's a number the market would determine. And that's highly deflationary in the bond market, as you just outlined, which means you'd have a great monetary contraction, which would make money some more valuable. I'll put that in quotation marks. However, if the Fed pivots and starts to print again, then you go into what some would call a hyperinflation. I don't think we're going to get a true hyperinflation in the US or in the world, but we get to a point where people shun the currency. And that's when the run to gold really begins. The run to gold's already started by central banks. That's pretty objectively the case. I mean, it's pretty easy to build that case. And yet, the repercussions have not been manifest throughout the global economy completely. Obviously, the trends are very clear. Food shortages, commercial real estate in bad place, stock market iffy, bonds having problems, put it politely. So most of these things will unravel by themselves. In other words, there's not much that the financial markets can do to forestall the inevitable. They can push it off, kick the can down the road, as vernacular is popular to say, but we've run out of road. And now we are going to see either a deflationary situation, an inflationary situation, or what's coined in the 70s, stagflation. And that's the most accurate. We're going to see inflation, what people refer to as inflation, in hard assets, food, water, insurance, rent. And we're going to see deflation in probably almost everything that's geared or leveraged, like stocks, bonds, money markets, insurance companies, pension funds, all those things that are related to or connected to the most secure debt that there is, which is United States bonds, which of course You think about it, it's really cash in the future. So if the dollar's gone from 100 pennies in 1913 to 2 today, and you've lost 98% of the value, then what's the value of a 30-year bond? Not much.
And yet, despite all of the doom and gloom about the financial system in the last few weeks, today JP Morgan announced a beat on profits, and their stock market was up around 6% pre-market. Is that surprising to you?
No, because you have to look at the truth. And if you take one of the major indexes like the S&P 500 or the Dow Jones, and you put it in terms of gold, you'll see that it's really not doing that well, although nominally everything you said is accurate. And that's what the financial markets focus on. For example, to make this crystal clear, if you look at the price of gold, I didn't check it today. I've been pretty busy this morning, but I'll call it 2,000. Well, $2,000 gold is the highest nominal price in U.S. terms it's ever been. Or 2,100 would be the new nominal high. And yet the 850 print on January 21st, 1980, in terms of an inflation-adjusted price, is far higher than the 2,100 would be today. So it's the same thing with the stock market. Even though you got a bigger number and it appears as if it's making a new high, in terms of gold, it really isn't. So I'm not surprised. In fact, that could be a prelude to more of an inflationary depression than a deflationary depression, which is the most likely one. And that's where people jump in the stock market to save their purchasing power, and it helps. But it doesn't help to the extent that precious metals do. If you look at the Weimar Republic, you'll see the only assets that actually kept you ahead of the hyperinflation were the precious metals. Yes, the stock market went up and up and up, but not keeping pace with the true depreciation of the currency, which we all know became worthless at some point.
You said in one of your weekly updates last month, and I quote, "If there's a huge market correction, gold ETFs and gold itself will most likely go down with it." So given you seem to be extremely bearish on the broad markets, does that mean you're taking profits right now with gold having risen 10% in 2023 and coming within stroking distance of its all-time high?
I'm not adding, I'm building cash. And what I said is accurate, what you quoted. Thank you. And that's temporary. So if we think about 2008 and when we had the financial crisis, and that's what the mainstream refers to it, we saw everything come down. And what came down least was gold, and it was off about 30%. And yet it was the first to rebound. So that's what I expect. The reason I say that is history shows it over and over, or at least near-term history. And the other thing is, again, using the word geared. I mean, almost all the gold holdings at an institutional level, I'm not talking about a central bank level, but an institutional level, is based on derivatives. And so they're easy to sell. You're selling an option or a futures contract or an over-the-counter agreement. And they're pretty liquid, and I think I'm right. But it doesn't mean that you shouldn't be in gold, but I wouldn't add at this time. And the other thing is the market says I'm wrong, and we get a new print high in gold. I would like to see silver confirm it, but at this point I doubt it would. So gold breaks out, I'd watch it for a few days. I'd look at the volume, and if those two things told me we're going higher, then I might add somewhat. But right now I'm just playing it safe, neutral. And we will have a new speculation coming out next month in the Morgan Report that's probably a company that no one else has heard of. I love that most of the time, but sometimes when you're the lone cowboy and no one else sees the story, that doesn't do very well. So that's what I've got.
Going back to the conservative element then of a gold portfolio, which would be physical, you recently said that while some investors might be reluctant to buy gold now, as it looks close to surpassing its all-time high in US dollar terms, by 2025, this price now around $2,000 an ounce could look like a bargain. And I think you even went on to say that you see it going as high as $4,000 in the next few years. But if you'd thought that back in August 2020, when gold reached its record of $2,075, you'd still be sat on losses to this day, and you would have been much better off cashing out at that point and going long the S&P 500. So why is this time different, do you think?
Well, I think, one, it's the run to gold, as I've said before, which means that central banks are buying gold hand over fist. It's the idea that gold is getting into the consciousness of investors at all levels, from professionals to retail investors. And you are looking at a situation where none of the markets seem to be working correctly. I mean, you have pension plan problems, you have defined benefit problems, you have Social Security issues that are coming up in the United States. And anyone that understands the financial system at a very minor level realizes that the debt's too big and what can be done about it. So it's a protection of capital that's already begun, and I think it will spill over, and that's why it's different this time. And let me just add something concrete to that. There's a lot of money sitting on the sidelines, and money usually goes where it's best treated. So with $5 trillion on the sidelines, if we took 1% of that, it'd be $50 billion. $50 billion represents 2 years' supply of silver, with all mining and recycling combined. Silver market right now is a $25 billion market. So just 0.5% of that $5 trillion moving in the silver market take the price much, much higher. And gold is more popular than silver by far as the establishment is concerned. Central banks don't buy silver for wealth preservation or a monetary asset. But that doesn't mean the public won't. So I think it's different this time because there isn't any place else to go. Yes, there's going to be bargains in real estate. Yes, there'll be some stocks for your stock picker. Yes, there'll be businesses you can buy. And all of that, of course, is true. But on the aggregate, in the whole, the best place to be will be the precious metals or the commodity sector. And that shift in consciousness is just starting to take hold now, but it will build momentum. And as it builds momentum, the run to gold will accelerate.